Rich Dad's Guide to Investing by Robert Kiyosaki, published in 1998. In the world of investing, 10% of people control 90% of the money. In Rich Dad's Guide to Investing, Robert Kiyosaki discusses investment strategies for people who want to make it into the top 10%. Kiyosaki became wealthy by learning how to evaluate investments and by teaching himself to build and sell successful businesses. Kiyosaki's financial education started when he was a young man, after he had finished serving as a Marine in Vietnam in 1973. Since he'd been in the military, Kiyosaki felt like he was lagging behind his peers financially. He had little money and no assets. What he did have, however, was a burning desire to be rich. His friend's wealthy father, whom he calls Rich Dad, agreed to help him become a sophisticated investor. Kiyosaki was drawn to Rich Dad's way of looking at the world, which was very different from his biological father's perspective. Kiyosaki's real dad had been a government official who was struggling financially after losing his job. Watching his real father try to make ends meet at the age of 52, Kiyosaki resolved to become very wealthy by following Rich Dad's advice. Rich Dad taught Kiyosaki that investing is a confusing concept because the word means different things to different people. Some people invest all of their time and energy into their families or their jobs, as Kiyosaki's real dad had. Other people who think of themselves as investors are really gamblers or speculators. Some are savers who hoard cash. And some are dreamers who are so caught up in predicting the market that they're afraid to take action. Even with traditional logic-based financial investing, there are many different forms. People can invest in the stock market or in other financial products, such as commodities, insurance, or real estate. Each area has many different subgroups where expertise is required to successfully navigate the terms and conditions. A savvy investor must learn the pros and cons of each area of investment to know when a product will be beneficial and when it might be detrimental to financial health. There's no one-size-fits-all approach to financial planning. It's always a very personal process. Many people fantasize about becoming wealthy, but they don't take the steps to make it happen. To become rich, attaining wealth must be one's top priority, more valued than feeling secure or comfortable. Often, people regard investing as a risky business. The truth is that informed, well-educated investors can manage risks while reaping huge rewards. Still, there are no guarantees, which is why it's important to use only excess money for high-risk investments. Broadly, there are 5 steps to becoming a savvy investor. The first is mental preparation. Investors must believe that they will become rich in order to do so. The second step is deciding on an investment style, which requires setting personal priorities. The next step is learning how to build a robust business, because creating assets is always better than investing in other people's assets. The fourth step is honing analytical skills to better evaluate the health of businesses and navigate tax laws. The fifth and final step is giving back to the community or to the world through charitable contributions. 10% of people control 90% of money, and that statistic is not likely to change. But there are more opportunities to join that top 10% than ever before. The information age and the internet have made it easier to turn an idea into pure profit. People who build wealth and invest it well don't have to work hard. They put their money to work for them instead. Analysis. Key Insight 1. Poor people fear scarcity. Rich people have faith that the universe is abundant. An individual's outlook on the world often shapes his or her personal finances. There are 2 basic types of money problems: having too little money or too much money. Poor people have too little money in part because they see the world as a place of scarcity, where there's not enough for everyone. Rich people, on the other hand, believe in abundance, which helps attract even more wealth. To some degree, thoughts shape material reality. A person who believes in abundance will always have enough money. but a person who fears scarcity will always struggle with money. Poor people who want to become rich must change their mindset. They must truly believe there is enough money in the world for everyone to be rich, and that they will eventually become rich too. All too often, though, poor people are driven by security, which thwarts their cause. Security and scarcity tend to go together. Instead of focusing on financial security, it's better to develop new financial skills. Those skills will help attract wealth, whereas obsessing over security can cause a person to stagnate. Money is an emotional subject, and people tend to let emotions cloud their judgment and guide their decisions. People who fear scarcity can't see the world clearly because of their panic. Key insights. 1. Poor people fear scarcity. Rich people have faith that the universe is abundant. 2. Investors should follow a financial plan rather than frequently changing strategies. 3. Many people lack the basic financial literacy that every investor needs to become rich. 4. There are 3 main types of income: earned, portfolio, and passive. Portfolio and passive income are the best types. 5. A good investor should be prepared for any eventuality. 6. There's no such thing as job security. High-level investors should aim for entrepreneurship. 7. Skilled investors learn from their mistakes. 8. A business should be conceptualized as a complex system. If any individual part fails, the entire system is at risk. Key insight 2. Investors should follow a financial plan rather than frequently changing strategies. Some people think of investing as the process of evaluating financial products or the action of buying and selling financial products. This is misguided. It's better to think of investing as a long-term plan that moves people from where they are to where they want to be financially. No one should ever invest without developing a detailed financial plan first. While investors need to hire financial planners, they must have enough foundational knowledge to go to those advisors with a clear idea of what they want. If the investor isn't clear about goals, the financial planner may find it difficult to develop a good strategy. It's common for people who think of themselves as investors to place too much emphasis on their investment vehicle. They tend to focus on one aspect of the financial world, such as the stock market or the real estate market, and ignore other financial vehicles. Some would-be investors make the mistake of becoming emotionally invested in the financial vehicle. For example, some people only want to buy the stock of companies they personally like. They pick and choose their investments based on these preferences, instead of following a strategic plan that will improve their financial standing. Investment vehicles exist to suit different financial needs. They should not be chosen based on personal preferences. Another misconception is that investing is a matter of great risk and blind luck. Investing isn't about making sudden moves based on new tips. It's more of a rote process. Financial plans should be boring and mechanical and disciplined to help remove emotional buying and selling from the equation. There are only 2 real reasons to invest: to cultivate a form of passive income or to build a financial portfolio. One of the most important elements of a financial plan is the exit strategy. All investors should know what signals they need to exit from a given investment. With the stock market, for instance, it may be tempting to sell based on emotions. Most people like to buy when the market is up and sell when it's going down, because it feels logical to follow the trends by selling when risk is more apparent and buying when opportunity seems to outweigh risk. But savvy investors have more self-control. They don't act based on emotional highs and lows, which can cloud objective judgment. Instead, the investors should have personalized, predefined criteria to guide their selling decisions, such as prices that would trigger a purchase or a sale. Key insight 3. Many people lack the basic financial literacy that every investor needs to become rich. A common misconception in finance is that only rich people can invest. But it doesn't take money to make money, as the saying goes. What is required is education, particularly a specialized financial vocabulary. If a poor person wants to become rich, the best strategy is to learn the jargon of the investing world. Even experienced investors confuse certain words and concepts, a mistake that can have catastrophic long-term consequences. For example, many people don't understand the difference between assets and liabilities. An asset always brings money in, so it should be noted as income. A liability costs money, so it should be noted as an expense. An investor always needs to be crystal clear whether a financial instrument is an asset or a liability. This may sound simplistic, but simple is desirable in the world of finance. A good investment opportunity should be easy to describe and easy to understand. If someone can't communicate the basic nature of an investment within 2 minutes, it may be wise to pass on that opportunity. Once investors have strong financial literacy, they have the ability to truly weigh and judge an investment opportunity. Financial statements are an important tool in this regard. Financial statements are the story of a business, conveying its history, its struggles, and its strengths. Good investors know that financial statements contain more reliable information than the price of stock, which is subject to the market's whims. The stock market isn't a reliable indicator of whether a business is strong or weak, and it should never be the primary data when considering an opportunity to buy or sell. But a financial statement, or better yet, 2 financial statements from separate years, will provide a far more accurate indicator of the business's health. Practice is the best way to become a better investor. A good way to train is to read as many financial statements as possible, as well as other tools like annual reports. Key Insight 4. There are 3 main types of income: earned, portfolio, and passive. Portfolio and passive income are the best types. Most income can be divided into 3 categories. Earned income is usually received in exchange for labor. It's the paycheck that employees receive. Portfolio income is also known as paper assets and consists of financial instruments such as stocks, bonds, and mutual funds. Passive income is money that requires little, if any, effort. Passive income can be derived from real estate ownership, patents, royalties, or license agreements. Of the 3 categories of income, earned income requires that the investor input the most time and tax payments. For example, a person with a full-time job usually works at least 40 hours a week. A person who invests in paper assets or who receives passive income will spend far less time making money. The money does the work. Generally speaking, secure investments take the longest time to mature. The trade-off for the security is that the investment makes relatively little money. On the other hand, risky investments are likely to pay off more quickly and handsomely, but there's a greater chance that the investment will be lost. To make risky investments, the investor should have established a firm financial base so that the loss won't be catastrophic. Many people fall into the trap of working hard and saving money with the goal of retiring eventually. In the recent past, people depended on the retirement plan and the benefits provided by their employer. In the contemporary world, such perks are less commonly offered and less secure, and itemized pensions are almost entirely restricted to public sector jobs. Workers are far less likely to stay with the same company for life. This problem is compounded by the fact that many people are living for a relatively long time past retirement age, meaning they have the potential to exhaust their retirement savings too soon. Often, poor and middle-class people are more interested in holding cash than assets. But saving in itself doesn't make people rich. Investment returns and compound interest are what truly create wealth. Also, having too much cash is dangerous for legal reasons because it makes people vulnerable to predatory lawsuits. Another problem for people with little money is that they're often taxed as individuals who pay much more in taxes than businesses and corporate entities. Individual earnings are taxed as income, as they're spent, and upon death. But businesses can be structured in such a way as to take better advantage of tax laws and pay less. That's why any person who earns income through a job should try to convert the money into paper assets or passive income. Key Insight 5. A good investor should be prepared for any eventuality. Investing well doesn't require making accurate predictions. No one can accurately predict the future on a consistent basis. Instead, good investors are simply prepared for whatever possibility might unfold. For example, savvy investors stay ready to leverage opportunities. Often the best investments are only available for a brief time, so investors should be ready to pounce as soon as they have assessed the opportunity as a good one. Investors need to be educated enough to assess the deal and rich enough to have the money available to follow through. The brain should be trained for signals to watch for, whether those signals appear in the form of a good deal on stock or a lucrative real estate opportunity. Investors who aren't well prepared may miss many opportunities. Investors must also prepare for downturns. Truly savvy financial operatives should be able to make money whether the economy is up or down. A lot of people are afraid to invest because they know the market could, at any time, decline and erase some of their principal investment. Good investors know the market fluctuates, but they have a strategy in place for how to react when a downturn occurs. Often, that strategy involves doubling down. Key Insight 6. There's no such thing as job security. High-level investors should aim for entrepreneurship. Many people think of job security as the cornerstone of a good financial plan. But a paycheck is not necessarily reliable. Even though some investors see a job as the ultimate form of financial security, it's contingent on employment that can end at any time. Even the most stable job is never an asset because it only belongs to one person. It can't be passed down to future generations. A better financial plan is entrepreneurship, which can be pursued part-time alongside regular full-time employment. People should never work solely for money. They should take jobs only to learn skills that will help them become better entrepreneurs. One good skill that a potential entrepreneur can learn on the job is sales. Good sales skills are vital for all entrepreneurs. Building a business, even on a part-time basis, is always better than investing in other businesses. Consider two of the most successful investors in recent history, Bill Gates and Warren Buffett. These men invested wisely, to be sure, but more importantly, they built very valuable companies, Microsoft and Berkshire Hathaway, and sold stock in those companies. Other entrepreneurs, like Jeff Bezos and Richard Branson, built highly profitable companies from the ground up. Many people have good business ideas, but falter when it comes to executing those ideas. Generally, people are better at generating new ideas than at translating a new idea into a functioning business structure. Prospective and beginning entrepreneurs are frequently confused by the best reasons to start a business. Entrepreneurs shouldn't worry so much about making incredible products that everyone wants to buy. Products are not the goal. Being a good business person is the goal. But some entrepreneurs become so emotionally tied to the products that they let their businesses falter financially. Key Insight 7. Skilled investors learn from their mistakes. In many fields, mistakes are generally considered bad. For example, in education, mistakes are a sign of ignorance. A student who makes many mistakes is perceived as an amateur in the field, or even unintelligent. Therefore, a hard-working student seeks to avoid errors. In the world of investing, however, mistakes can't be avoided. They are inevitable. Therefore, an essential characteristic of a good investor is to look upon mistakes as a learning opportunity. Emotionally, the mistake might feel unpleasant to the person who made it, but intellectually, mistakes are rich experiences that contain wisdom and valuable lessons. In the context of investing, something profitable can come out of a mistake. For instance, a failed venture might yield a contact for a future business partner. The trick to managing mistakes is to take the time to learn from them properly. It's human nature to want to move past an error as quickly as possible. Skilled investors learn to set aside their emotions so they can develop and grow from the experience. Key Insight 8. A business should be conceptualized as a complex system. If any individual part fails, the entire system is at risk. A business is one large system composed of many smaller interoperating systems. No small system in a business stands alone. They all work together for the greater good and often have overlapping functions and personnel. Common systems that comprise a large business include daily operations like answering the phone and backing up data, product development systems that create wares and packaging, a customer service department that deals with returns and complaints, human resources, manufacturing and inventory, order processing, and accounting. No single system is more important than another because they're all essential to the functioning of the business. The CEO's job is a matter of systems management. Each individual system should have its own leader who is accountable to the CEO. The CEO must be sure that all of the individual systems are running optimally. Critically, the CEO also watches individual systems to assess weaknesses. Any weakness has the potential to bring down the business. One particularly dangerous time for a business is a period of rapid growth when systems are strained and in flux. A good CEO should anticipate growth at different levels so the business is always ready to move to the next level. That might mean increasing production or having access to larger lines of credit. As a business matures, its systems should get better. Over time, employees should find that their jobs are easier to perform. If their jobs become more difficult, that's a sign that better systems must be developed. Systems that are poorly designed tend to be labor-intensive. Systems should be as automated as possible, which will eventually help make the business easier to sell. Documentation in the form of a policy and procedure manual can help businesses standardize key operations. Often, as they develop such a manual, the CEO and leadership team will discover new ways to boost profits and streamline processes. Author's perspective. Robert Kiyosaki is best known for his 1997 bestseller, Rich Dad, Poor Dad. He frequently references that volume and another one of his popular books, Cash Flow Quadrant. Rich Dad's Guide to Investing discusses entrepreneurship as much as traditional investing because he sees business ownership as the ultimate investment. Kiyosaki writes from a dual perspective, blending his experience as an investor and entrepreneur with his perspective as a young man learning about finance from a mentor. Many of his beliefs suggest an orientation in New Age thought, influenced by the New Thought movement, which generally holds that an individual's reality and experience can be altered and controlled with the power of concentrated thought. Important people. Robert Kiyosaki, the author, is an investor and entrepreneur. Rich Dad is Kiyosaki's mentor. Rich Dad is not his biological father. He's the father of one of his friends. Poor Dad, or Real Dad, is Kiyosaki's biological father. Kim Kiyosaki is his wife. Author's style. Robert Kiyosaki explains most financial principles by recreating conversations he had with the man he has nicknamed Rich Dad, who served as his financial mentor for decades. He supplies definitions for key terms and uses diagrams to explain critical concepts. The text is divided into 42 chapters, a short introduction, and a conclusion. Kiyosaki further divides the 42 chapters into what he calls the 5 phases of investing, which are mental preparation, choosing an investment style, building a strong business, becoming a more sophisticated investor, and giving back to charity. Most chapters end with something called a mental attitude quiz that helps readers assess their perspective on financial planning and investments.